Larry, here's what I'd like to begin with. You talk to world leaders, you talk to central bank presidents, you talk to the CEOs of the world's largest and most powerful corporations. When they want to understand what's going on in financial markets, they turn to you. When they want to understand the impact of fiscal and economic policy, they turn to you. What are they asking you?
In most cases, I'm asking them a lot of questions when it comes
I'm sure.
to CEOs in terms of their business. In terms of regulators and political figures, obviously they're asking me what we're seeing. I think the biggest question being asked today is, where can interest rates go? And another question that's heavily asked is, where is China going? I think those are the two biggest uncertainties that are in the marketplace. And it's funny, most people don't ask the question about Europe. People asked about Europe a lot over the last few years, and Europe is now third or fourth on a list of worries.
So let's start to answer those questions. The bond market has all of a sudden become very treacherous. Where are interest rates going?
Well, interest rates have backed up about 90 basis points, and we saw a 3 to 4% drawdown in mutual funds in the past few days, few weeks. But we're still at historical low rates. This is the problem that I see for bonds, that we were at such historical low rates. Normalized rates are higher. Even our government's estimates for 10-year treasuries for 2015 is 5%. And I think I said this the last time I was there in the CBO estimates when we talk about deficits. So interest rates over the course of years will be higher.
But there are a lot of people out there who are scared right now. You don't sound very scared.
Well, they'd be stably higher.
I don't get frightened when you could forecast this out over years. To me, it should not be a shock to anybody.
The biggest non-surprise surprise?
Yeah. I mean, to me, rates are going to go higher.
Yeah, but how far and how fast? That's what everybody's trying to figure out.
How far, how fast is going to be dependent on economic information. So we're going to see a bias towards higher rates. We may be in a trough right now where we're going to sit here for a while at 250 to 275. But over the course of time, with my views that the economy is going to continue to improve, with my views that employment will continue to improve, with my views that Europe is stable, that we are going to see a biasly rising interest rate environment.
So can you be still 100% all in equities in a period of sustained higher interest rates?
Well, I'll be able to answer that question a lot more when we see earnings for this quarter, but it is my view, for many reasons, that being in equities, as I suggested 2 years ago and last year repeated, to be 100% in equities is the right trade. And year to date, I mean, we've seen some very large moves. The long-dated U.S. Treasury market is down close to 10% year to date. S&P's up 16%. We've had a 26% change in valuation in 6 months. So obviously a lot has occurred. So for me to tell you equities are going to continue to rally, I need to be certain that earnings are going to remain strong. And from my conversations with many people, I believe earnings are not going to be missing estimates. Earnings are going to be coming in, by and large, positively biased. And we saw that already with Alcoa yesterday.
So within the framework that you've just outlined, what's the survival strategy? What should people be doing?
So for those who have the ability to move to equities,
still go 100%.
Well, no, I'm using that as a mouthpiece to try to have people think about that. Most people can't do that, and most people shouldn't do that.
Insurance companies can't do it, for example.
They're not allowed to. Well, the capital charges are so severe, and same with banks. So if you compare 94, a lot of people compare 94 to this. 94 was totally different. 94, there was much more flexibility moving one asset class and another asset class. 94, you had a 6.5% drawdown in mutual funds and bonds. You had also had a 6% increase in interest rates. As I said, we've had a 3% drawdown and only a 90 basis point decline. And much of the reason why that's muted today, even where you think interest rates are going to go, obviously at a much lower level than where it was in 94. But more importantly is most institutions, official institutions, banks and insurance companies can't own or are inhibited to own equities.
So looking in the entire fixed income universe, is there anywhere that looks safer or to be a better bet than others?
Well, I believe there is going to be a great rotation in bonds, but the great rotation is going to be within the bond universe. So we have been talking to many pension plans, insurance companies, to start thinking about moving away from bond funds that are targeted to a duration. So most bond funds are core bond funds that are targeted to the Barclay Aggregate Index. The problem by being targeted to this index, we have an aggravated problem. This index is extending its duration. So at the beginning of the year, the Barclay Aggregate Index had a duration of 4.8 years. So it had 4.8 years of risk. Because of the convexity issues or the mortgage prepayment issue that's embedded in the aggregate index, the Barclay Ag is now 5.5 years. So it actually is riskier to own that bond fund today than it was in January. And so what we are suggesting, people move to unconstrained bond funds where duration is not targeted to that index.
Speaking of duration, there is a well-known bond fund manager on the West Coast who has lately lost a lot of money betting on duration and betting on inflation. Is there any hope for that trade in what you just outlined?
It is my view, and I'm not going to discuss.
I didn't name names.
It is my view that inflation is going to be very muted. I don't see any inflationary risk at all. I think that bond fund manager is saying there's not going to be inflation too. So, but I agree with that. I just have a different outcome in terms of the economic future. As I suggested, I think we are going to be in a 2 to 3% economy. We're going to have improving labor markets, and much of it has to do with my view on energy in this country, where we have a sea change in manufacturing in this country. We have just huge opportunities for job growth in the manufacturing sector.
That same bond fund manager declared a couple of months ago that the bull market in bonds was over. It's been 32 years. Do you feel the same way? I mean, think about it this way, is what we've seen over the past little while a correction during the late stages of a bond bull market, or have we seen the fundamental shift? We're not going back to where we were for the past 32 years.
I think I said that 2 years ago when I said you should be in 100% equity. So it is my strong view that we are going to be in a cycle now, whether it's 5 years or 10 years.
It's over.
We're going to have rising rates.